Hey, Kimberly, how you doing? TGIF, huh?
All good here. How's it going with you?
Not too bad, really. It's kind of chilly out, but it's Friday. Gotta take what I can get.
Yep.
In my area, we got races this weekend. It's kind of a special event. They don't normally start so early in the year, but tomorrow night is the races, so I think we're gonna go do that.
Did you rip and run a few days ago when it was like 80 degrees?
I got out and around, but we haven't had the motorcycle out since that one Friday 2 weeks ago.
Yep, spring is coming.
I'm ready. I wish it would quit teasing us and just do it.
It will.
And then we'll all be saying, "Oh gosh, it's so hot."
It's so freaking hot outside. I can't move.
I worked on the drilling rigs for years in the harshest, nastiest climate. So most of my life, I worked outside in all of that mess.
Yeah, so you're pretty much used to it.
I used to be, for the last 6 or 7 years, I've been working in an office, and now I'm such a sissy. I go outside and I get cold so easy. I get hot so easy.
I
Ah,
don't know. This weather is different nowadays. The hot is hotter. It seems like to me, it's like it's gotten crazier to me.
I would like to think that, that I'm still the same person and I haven't gotten soft, but I have a sneaky suspicion I've been in the office too long. So let's see, make sure I'm recording everywhere that I need to record. I'll just do it here too, just in case. Why not?
Recording in progress.
Aha! That way, if something goes wrong with the restream, then we've got that one. Don't really have a lot of topics today. We got a couple, so we'll at least be able to get started. But topic requests are always welcome. If you guys got something that you want to hit on, if not, requests during the week are always appreciated. I just add them to the list and then put a big list together. I had zoomed in on this week's volume profile because earlier today we were making a run up into it. We tagged the profile, kind of overshot it a little bit. Now we're back down into the value area low. If we break that value area low, we're looking for the low of the week to be tested. And there's not a lot of options structure left down there. We're getting too close to OPEX. But I mean, there is a little to be sure. There's not a whole lot. So one topic was somebody was having a hard time trading today and recognizing that it was a nasty trading day. And the request was, well, how do we know what kind of day we're going to have until we get into the day and start doing the thing? And there is some tricks that you can use, but at the end of it all, um, we really just need price to start to play out to give us something to work with. So yesterday, for an example, was really nasty, a lot worse yesterday than it was today. And even back on Tuesday afternoon, we got up into that trash and it wasn't much better. But it's been some rough days this week, and the idea is I really don't bother trying to trade when it's nasty. I might call something nasty and quit looking, and then it cleans up and I miss something good. But more often than not, if I call it nasty and I go look at something else, I'm usually not missing anything. That FOMO is real though. A lot of people spend all day long waiting for it to clean up and give them that one chance, and I just don't. At some point, my family was asking, "Are you ever coming out of that office?" Because I was in here pretty much if I was awake, I was in the office looking for another chance, looking for something else I could learn, something else I could trade, something else I could do. But you got to live. If you just never get out of the office, you're never going to spend time with family, get anything else done. So I became more strict about what I want to trade, what I'm looking for, and what I'm willing to sacrifice time or money, whatever. So, one good way to deal with this is by looking at where we're at when we get into the market open. We'll use yesterday for an example of this. When you're trying to figure out once the bell rings at 9:30 if it's going to be a good trading day or not, is are we opening up inside of the Globex range? Because if we are, that's our playground. We're going to have to get out of that if we're going to get anything else done. And if the range in the Globex is really big, then hey, you might find something tradable. But a lot of times the Globex range is really narrow, and that means our playground is really small. There's not a lot of room to get anything done. This is about 60, 50 points, top to bottom. 50 points sounds like a lot, but there's not really a lot of room in there. And then when we did get outside of it, we turned around and we came right back in again. On the one hand, that is exactly the kind of stuff that I like to trade. It's reversals off the edges or breaking out of the edges. That's my sweet spot. I don't want to trade in the middle of a zone or a range. Certainly not inside of multiple candles that are all just piled up like junk wood. I don't want anything to do with this stuff. So for me, if I'm trying to find an opportunity to trade, I look around. I don't I don't like a trade to sneak up on me. You should be able to see that trade coming from a mile away. If you're trading against the highs, you already have a high and you're looking for price to go back and test it. So you already know where your trade is. It's against that high. You just need price to go back up there. If you're looking in a bunch of trash and we're sitting in the middle of it, what I see in the chat or what I get from others who are asking me questions is we'll be in the middle of a range, in the middle of trash, and they'll start asking questions like, how likely is it that you think we're going to go to the high and break out, or we're going to go to the low or break out? How likely is it that we're going to go up or we're going to go down? What's the odds? And all of these questions, which makes me think they're trying to trade in this mess and they're trying to get some edge and guess and assume. Good luck with that because it's a coin toss. It's a 50-50 maybe. And I don't want to guess. I don't want to assume. I'm not trying to gamble. My trades are on the edge. So rather than guessing or assuming or thinking that I can figure out which edge we're going to go to, all I have to do is know where that edge is and wait for it to get there. And when it gets there, make a decision about which way I want to go. A lot of times the decision is already made. Before we get there, I've already got a pretty good idea that I want to go long or I want to go short. If I don't know, that's okay. I can just wait and see what price is going to do. But I'd rather know in advance when I can so that I already know what the plan is. I don't get as many trades this way, but that's okay. There's a lot of things to trade. I like copper, gold, silver's all right. It's a little thinner than I would like. The ES, the NASDAQ, there's plenty of things out there to trade. And even if I step away from futures, there's stocks, options, there's always something. I don't need to compromise just to find something to trade. So if I don't like what I've got, if price isn't going to a place that gives me edge, I'm really just not interested in trading it. I have found this to really change the ball game. It changed the way my profits looked at the end of the month, even at the end of the day and at the end of the week. It changed my approach to trading. Um, Trading sloppy, nasty stuff makes you second guess. It gets you to doubt. Maybe my system's not that good. I just took a loss. I just took another loss. This trade isn't working out. We start second guessing ourselves, our trades, our strategy, our setup. Then we lose confidence. We lose faith in what we're doing, and the whole darn thing just unravels. And then we have no trust in our trades, no trust in our setups, our abilities. But good trades add to good trades. At least they certainly did for me. You get a really good trade, it works out just like you planned, execute it correctly, and it feels so good, you want to do it again just because it felt good. Of course, I'll take the money while we're at it, but it feels good to have a plan, execute it correctly, and it all works out the way it's supposed to. And you want to do more of it. Human nature. You just want to do what feels good. So it kind of feeds on itself. I think we all have problems with bad habits, and you can pick up bad habits in live trades, but you can also pick up bad habits in paper trades. It's one of the dangers of paper trading. So you got to be very careful if you are paper trading to not pick up habits that later on you can't get rid of. Revenge trading, over trading, scalping. We can talk about that scalp word for a moment too. If you look up scalping, the textbook definition is that you're going to take an overly large position for a small move in the market. You have a very, very high win rate with a nasty risk to reward. And you're going to do that frequently, a lot, 50, 100, 150 times a day. That is not my trade. I do not do that. I'm not interested in doing that at all. But we all throw that word scalp around a lot. I see it used often. So really kind of consider when you're thinking about what a scalp is or discussing what a scalp trade, if it matches that definition or not. And who you're talking to, make sure they understand so that both people understand the word scalp. It is important to understand that because I've talked to people who say scalp and they have something completely different in mind. So then we're not even thinking of the same thing when we're discussing a scalp.
You're gonna eat rice and sabaw and banana.
Let's see. I'm reading through some notes here. Yeah, gaps are certainly helpful. Um, Intraday gaps would be great if we got them, but the futures really don't intraday gap that much. On the other hand, the futures do have extra gaps, like the gap between 5 and 6 p.m. That's usually a gap that we can play with. And then the gap from uh, 5 to 9:30, that's another gap, right? The end of day gap versus the 9:30 open gap. So it's not the same as equities, but at least we have something special. Now, the wide range bars on the open can be a tell for a nasty day, true, but not necessarily always. It To me, it's how is the first 30 minutes, right? We were talking on Wednesday about market on open orders, those MOO orders, and how because of those orders sitting in the queue when the market opens at 9:30, we often don't see the directional movement that we would expect, right? Price might be going up, and then the bell rings, and all these market on open orders come in, and we drop like crazy. And we're like, why are we dropping? We was bullish. What happened? The bell rang and we're falling. Well, we didn't suddenly get bearish. We just had to wash out all of those market on open orders that were short orders, very likely just close orders. And then once those were done, we buoyed right back up to where we opened and maybe even went higher. So those first 10, 15, 20 minutes, even 30 minutes, oftentimes they don't help us with the trading day at all. Now, don't get me wrong, I like open range strategies, things like the 5-minute open range, the 15, the 30, even the 1 hour open range. So we can take the range of that first 5-minute bar, mark it out, project levels from it higher and lower. But I'm usually hesitant to try to define market direction for the day or even for the morning based on those first few candles, because they're not based on price action. They're based on pre-market market on open orders.
Right, but the reason why I brought that up, because if you look at that one wide range bar in the regular trading, you were just showing it, the regular trading hours, yeah, um, the 5-minute candle, you had it up before, but I don't know where it went. Um, that one, yeah,
I
there
think
we
it was
go.
this one. Yeah.
Yeah, even though I wait for the first 30 minutes too, right? When I saw that candle shoot up like that and then go down, I was like, oh boy, this is going to be one of those days. And sure enough, within the first 30 minutes, you just see these wide range bars. I tried to, when I saw that big one, I said, I better paper trade this to see if, because this doesn't seem like an environment that will turn out good for me. And sure enough, I couldn't, even paper trading, I couldn't get a good, um, get any traction on it. It was up and down, up and down. And it was, that's just part of what I'm noticing is that when they shoot up, I mean, that thing shot up so quick. And I was like, oh boy, here we go. And then everything else just got really wicky, these big wicks, which told me, what is this thing trying to do? It's like it was just trying to sweep stops all over the place.
Price action is a really good tell. You're 100% right. Trying to get a feel for that behavior can really keep you out of some bad days. I wish there was just some perfect little thing that we could point to and be like, oh well, the light's green, so we're good to trade, and the light's red, it's too nasty, we should sit out. So those subtle little things that you're picking up on is excellent. That's exactly what you want to do. Got to get a feel for the market. I remember I was listening to this guy years ago. I was just getting into the day trading side of things. I had been swing trading for years, and he was in a live stream on the ES, and he was on a 1 minute. And this is a guy that helped build Thinkorswim. Like, he's been in the industry forever. He did all of the education for the TD Ameritrade staff that was helping develop the Analyze tab. So he's a very smart guy, and he's well liked, well known in the industry. And this pillar of the community was on a 1 minute ES futures chart, live streaming to people. And he's just randomly throwing orders on, taking them off, throwing them on, taking, like, no care in the world, just laid back, getting in and out, chit chatting, live streaming. And his live streams had, I don't know, 1,300 people in it, right? Like, it wasn't 13 people, it was 1,300 people. And you would think the guy would be nervous. He's live, and he wasn't one lotting either. He had lots and no micros, just minis. This guy, very comfortable in what he was doing. And he was talking about volume that day and about how you got to know the product that you're trading. And what he was referring to was how volatile it was. And people were asking him, like, where's your stop? You don't even have a stop on. You're just getting in and out and moving your trades around, but you're not even using a stop. And he's like, oh no, it's a laid back day. Price is very calm. He says, yeah, look at volume. When you are on the ES on a 1 minute, he said, what's the average volume? And he was being serious. Give me the answer. What's the average volume? He says, you guys trade this market every day. What is the average volume for the market you're trading? And they couldn't answer. Of course, I couldn't answer because I hadn't been trading futures at the time. So he said, if you know the average volume for the time frame that you want to watch, then you should know when things start to get a little out of control because volume will start to pick up. And he said, my getting out of control number on the ES is 10,000 contracts on a 1 minute chart. He said, that's what I'm looking for. If I don't see 10,000 contracts a minute on the ES, then I know that we're not getting into heightened volatility that I need to be concerned with. He says, so I'm not concerned. We're not hitting 10,000. He says, we're not even hitting 6,000. At the time, this was way before COVID, and the volume was much lower than the average volume we're looking at here. I think it was running between 18 and 2,300. And right now we're running between, say, 4 and 6 for the time period that he was looking at was like back in here. So what the average price action looks like for whatever product you want to trade really helps. It's why we don't recommend people jump from product to product to product when you're first starting out, because you want to get familiar with one. So you learn these little nuanced things like, how does price move when it's behaving normal? What kind of volume does it get when it's behaving normal? And even if you're not looking at it from that point, price has attitude, it has personality. So, like the NASDAQ, ADHD, it's all over the place. It can't sit still. It stutters. Maybe it's a bit of a social butterfly. It's just everywhere, all over. The ES is more reserved. It's laid back. So get
Well, yeah,
familiar.
when SPY, because I don't do futures, but even with the SPY, I can tell it's going to be a normal pullback. Like today, it was a good fade. You gapped up, and then sure enough, it had the first candle of the session. We had this huge spike. I said, okay, that's fine. It's not bothering my first 30 after first 30 minutes. And I knew it was going to be a normal day. Whereas yesterday it slammed up there and then slammed back down. I was like, oh boy, it's gonna be like that today. But today you knew you could fade it easy. But yesterday it was, and I think even the day before it was horrible.
Those subtle little things are what will help you grow as a trader because they matter so much. It's one of the reasons I'm not a real big fan of indicators. It keeps us too far away from price. If we're looking at some indicator, then we're missing out on what price could tell us, these subtle little signals. So I'm much more interested in listening to what price has to say rather than looking at indicators. And I would say you just made the perfect argument for why price is the better route.
It's the better route, but I didn't include this fun fact is when I use your fibs, that's the other thing. After the end, when 30 minutes hits, that's when I put on my fibs, right? And I couldn't even get a handle on the fib because it was moving so fast, and it was like I'm gonna wipe out this set of of of, of I don't know, orders, and I'm gonna slam back down and run. I was like, oh, okay, because I couldn't get a handle. I said, okay, I'm staying out of this because when the other times when I took trades, it was no problem. I could set my fib and just wait for price action to hit the area I wanted to hit and then take the trade. But the Thursday, Wednesday and Thursday, it was horrible.
That will get you a lot farther just doing that right there. For those who haven't got to the point where they can read price as well, it will help to look, where are we? If we're inside of that Globex range and it's a narrow range, then you're going to be dealing with a much choppier, more violent price. Look at today on SPY. We had a really wide Globex range, and price, until it got near the lows, was offering some relatively decent price action. It would leg down, build a little flag, leg down, build a little flag, and it was working out really well. You guys can see my screen, can't you?
I can see it.
Someone was asking in the chat, and it was just making me wonder why they can't see it.
Yeah, I can see it fine.
I thought so. I figured if I wasn't, we would be hearing it. I can see it on YouTube. People are in the Zoom can see it. And that guy who's asking is in the Zoom. So I'm not sure why he can't see it. But it's there. It is interesting how many times I get asked every day about odds, statistics, how likely it is that we're going to leave a range higher and lower. Something that you guys can really work on is identifying where you want a trade and waiting for price to get there.
Well, that and going back to your fibs, I love those fibs. I'm sorry if I keep bringing it up, but the other thing is, if you can, you're gonna. I mean, I have to test it out some more, but you're gonna have a good day of either going long or going short if you can put your fibs on it and it holds. But when you can't even figure out what direction it's going in because it's like it's just wiping out orders and it's wiki and I'm like, okay, I could see this is not going to be the day. And then I just close it and look for something else or just stay out altogether.
Exactly right. If it's not obvious enough that you can see it, then it's telling you to sit out. It's begging you. Look, you can't see it. Don't guess, don't assume, don't roll the odds and try to figure out what's more likely that we're going to do this or that. Just sit out because it's not giving you clear indications and clear direction. Now, I have brought it up to people just like that, and they say, well, I'm so new, I don't have any confidence in any of it. And then, of course, that begs the question, then what are you trading for at all? It should be trying to study and learn those price patterns, learn something before trying to trade, because trades should be done with confidence.
Well,
Easier.
that's what the fibs of that's why I use those fibs, man, because that thing it just gives you tells you it signals to you where to get in and where to get out. It- I'm telling you, people need to really go back and listen to your recordings and just study it. And it's I don't know if I it works.
Well, fibs also give us the measured move and the 111, which I learned from Signet. But I have to admit that in my case, 111 and the 236 was a big game changer for me. But the measured move, I mean, a fib is a measured move. It's just, you may be using the 618 instead of the half. You may be using the 786 instead of the 3/4, stuff like that. It's still a measured move. It's just you may be using different numbers. But overall, measured moves rule. They absolutely do because markets respond to that over and over and over.
Signet, I'm not trying to blow you up or anything, but I tell you, if you ever decide to write a book, you would make a gag of money because this stuff really works. With other people, it's like it doesn't jive with what they try to tell you. But this really holds. Even right now, price is just hanging out around the 123, like Marzini mentioned, it's just hanging out there and it's not doing anything. It's the perfect place to not take a trade or just to wait for if another move comes, but it's stopped right there.
I am working on that book, by the way. It's It's a little slow going, but there's no rush. I want to get it right, and it's in the works. The there is something to consider right now with the state of the market and how everything is locked on the risk of crude. And it doesn't mean that we can't lose, but if this Strait of Hormuz situation drags on, markets are going to get worse. And at some point, we might see intervention from the bond vigilantes, and global market relapse is on the table. And it could get really nasty before it cleans up. We always go back up. That is, so far throughout history, markets have always gone back up. The problem is, um, some people can't wait for it to go back up. I remember during COVID, I had so many retirees reach out to me who had planned to retire in 2020 because, we didn't know COVID was coming. If you were working in, 2019, 2018, and you're like, oh yeah, man, I'm going to retire when 2020 comes around. And then you go to retire and the market's down, your 401k's down. They didn't know what to do. It wasn't a good time to retire. It wasn't a good time to take money out of the market when we were down in those lows. So you can't always assume that you're going to be able to get out at an appropriate time, but markets do go back up. So if you're not nimble or you don't think you can time things well, don't bother trying to do anything. Just sit tight because we'll go back up. Otherwise, if you're looking for opportunities, if the global market does collapse, it's not going to be a stock picker's market where you have to pick and choose what's going to fall. Everything is going to fall. You can examine a bear market to get a better look at that. So I'm on SPY. We know that we had a bear market just a few years back, 2022. So we could just jump back a couple of years and get a really good look at what does a bear market look like and how did stocks behave in that bear market. So this is the index, the ETF on the index. We know what SPY did or what the Qs did, but you can take that same window of time and you can go look at, how Tesla and Amazon or whatever it is that you want to trade, how did it perform in this bear market? Because that's the risk that we're looking at right now. Massive drawdowns. A bear market is often classified as a 10% drop from the highs. Other analysts will use 15, some will use 20, but we're talking about a significant drop away from all-time highs in the indexes as a qualification or a classification that we have entered into a bear market. There's certainly other things that you can use to quantify that value, but I like that distance from the highs as a generic example of how far we would have to go. So what does an 11% drop from all-time highs look like in SPY? And I'm not going to get this perfect. Close is close enough. It looks like 620 on SPY. 620. That's not that bad. 620. So if I was shopping around for some options, I now know where I'd want to start looking. 10% or lower, right? Then we have to be worried about, well, what's the time frame for this trade? Because options are not cheap right now. If I want to go buy a put in SPY, I'm going to have to pony up some cash. A day trade, sure, it's not going to be that expensive. But what if this was Tesla or Nvidia and I was looking at August or December? That's thousands of dollars per contract. Even on SPY for December, we're looking at $4,088 a contract at the money. 620 would put us out at around a 30 delta. That's not bad. That's a tasty trade area. I've heard them talk about the 30 before. Not a lot of liquidity out there, at least on the volume. Open interest is fine. Here's some decent open at the 600 strike, but that's still $2,400. We could, of course, turn that into a vertical. I'm risking $1 in a $5 wide trade, and that's pretty common, right? We're risking 1 to make 4. It's not gonna, expand into massive amount of profit, it's got a capped profit and a capped loss. Worst case scenario, I lose all of this money. It's a $106 start to finish plus commissions. That would be the worst that happens. Of course, I can get more than one, and then I can fade the play as it unfolds. And if you can afford it, you could just start with a put and add the short put later on if you wanted to. There's no reason that you have to start with the full spread. You could try butterflies. They're cheaper. You could even begin a legged in iron condor. And the idea behind that is with an iron condor, you have a short call vertical and you have a short put vertical. They're the same size. So $5 on one end, $5 on the other. Price needs to stay in between those two short verticals, and that's an iron condor. If you want to leg into one, then you could start with, say, the call side, put on the short vertical, and then add the put short vertical later. I like to do these kind of legged in iron condors at the money. And that's because I'm a little bit of a stickler when it comes to how much risk I'm taking with these credit spreads. I don't like the ones that are far out of the money because there's just no proper way to manage them. Near the money, I've got more control. I also get a lot more credit. This is offering $3+ in a $5 trade, which is A, fantastic. I mean, how awesome is that? But B, it's also a warning. It's a sucker's bet. They're saying you should totally sell this. You should totally do it. Come on, here. We'll offer you extra money. You should sell to open this trade. We'll help you do it. We'll give you more than it's worth. Come on, do it. Doesn't it make you nervous when they're trying to bribe you into taking the trade? They're offering you an incentive and extra money. It should, because we all know that the trading world is dirty, conniving, deceitful, shady, shenanigans everywhere, right? Everybody knows not to trust the big brokers and funds and firms and institutions. So if they're trying to offer you extra money, you should be nervous, right? But there it is. This trade is worth $2.50. Why are they allowing me to take it at more than $3? They're just giving me money because they like me? Probably not. They're enticing us to take the trade because they want it. They want to buy it. They need someone to sell it. On the other hand, this is what I want. This is what we were talking about, right? Putting on a short call. Maybe we should try a different expiration. We don't need to go all the way to December. In fact, we were talking about midterm elections today. And if we were thinking about those midterms, we could at least move up into, what do you think? November would be nice, but we don't have any Novembers. Maybe we could look at the September contracts and look at the 600 on there. Or no, we'll start with the call side. When we got some calls that might look good. These are all in the hundreds on volume, so nothing really stands out there. The open interest gets heavy way out there, like at 7:30. I wasn't looking to go that far, but just curious, how much money could we get if we went to 7:25 and 7:30? $1.65 in a $5 wide trade. That's more than I expected to be blunt about it, but whatever. Let's move a little closer. We're looking for at least 250, right? That's the sweet spot. There's 244. 254 right there. So we can use 695, 700. We are out of the money 30 points ish for our short leg. And we've got half the width of the spread. And that's all I would need right there to start this legged in iron condor. So here's half the trade. Let's turn that green one off there. Show the risk profile. Come on, Thinkorswim. Yabba dabba doo. There you go. So there's the call side, and it's only half the iron. We need to bend it over on this side and put it under the zero line and just mirror this over here. We want to do that with puts. The only qualification for this is that we need a $5 wide trade, and we would preferably want half the width of the spread again. Now, we don't want these puts right now, right? I'm just going to show you what we're eventually aiming for. We're looking for $2.50 and a $5 spread. So I'm going to find that. Maybe. Man, they're really holding on to those puts tight. They don't want to share. Let's just put it out here and we'll change the value. We'll throw that into the Analyze tab. So say we found the out of the money puts later on, and we go to add those, and we also get $2.50 in credit. That is the iron condor that we're looking for. Notice it's above the 0 line. Typically, an iron condor has some line that runs through it. And where'd my drawing go? Come on. And that line is the break even, or the 0 line. I hooked up a Steam Deck today, and I had to reboot my computer, so I forgot I turned this tool off. There it is. So typically there would be some line here, and this would be our profit area, that would be our loss area. But if you leg in with the same amount of credit as the first one, and the credit is equal to half the width of the spread, you end up with a no-lose trade, which is what we have here. This trade cannot lose. The worst case scenario, because we got $2 extra, is that we only make $2, which is awesome. That would maybe cover some of the commissions, but we need to start with half the trade. And since we're on the side that needs the calls anyways, if we're looking for the market to fall down, we want to put those calls on now and then worry about the puts later. At any time later, we can add short puts at the money, just like we're adding short calls at the money, and we can lock the other side in, which means if we only fall to, say, 650 and we stall there, we could put the short puts on right there, and boom, we've got a legged in iron condor. There's no criteria for where those puts get added. We can add them at any time. And if it just falls and falls and falls and falls and never bases, we don't need those puts. It would just be nice to have more money, right? There's nothing wrong with that. I like money. So all we're looking at is starting with those calls. And so we got the calls. We want to put the break-even line on the chart so we know where that's at. It's right here, 697.50. Let's put that line out there with the candles. Oh, I had too many lines out here already. See, it's not that one. It's not that one. Let's do it again. I guess it was that one. We need to rename it so it won't move it on us. Short call, break-even line, September expiry. That way, if we do anything else and we tell it to send lines, it won't wipe that out. If you don't do that and you leave it named whatever it was when it drew it, it'll remove that line and put new lines out there. And then that sucks because then, it's just randomly taking lines away from you. So that is our call side. Between now and September, we need price to stay under it, or worst case scenario, we need to be back below it before expiration. This trade is risking 250 to make 250, and as you can see, we are quite a distance from real price. So we have this much room as a buffer. I'm not even a fan of out of the money option positions, but this is half the width of the spread, which is why I like being at the money, and we're getting that. So I'll take it. We would know to close this trade if it breaks through the high up here. And since this trade is a 50-50, we're risking 250 to make 250. I wouldn't close it at all until time became a risk. So when it got below, say, 3 to 5 days to expiration, because the thing is, if I did end up in the money, I would be concerned. So if we get too close to expiration and I'm in the money, I'm going to be worried. But if it's out of the money, then that's on me. I'm just making profit. And if we're not too close to the at the money, I'll let it ride a little closer to expiration. So that this one is the call side. If we can do it in SPY, we can do it in anything. Because if the market does fall because of the cost of crude or energy in general, and if everything falls, go shopping around. Consider for yourself, what would you like to short? It doesn't have to be something that is $700 like SPY. You could choose something that's a lot cheaper that might fit your account better. XLF is an ETF that I like to trade with a smaller account. It has smaller option widths. Of course, it's not as liquid as SPY, but you know, and nothing is as liquid as SPY. Sacrifices will have to be made, but you can poke around, try to find something that you would like to trade if the market goes down. Try not to pick things that can do well in high inflation environments. Maybe avoid value companies or value ETFs, right? Like staples, commodities. People are going to eat even if the cost of fuel gets really expensive, right? Yeah, airlines are having problems, but they've been having problems too, right? Because of homeland security, and they're not getting paid, and they're not going to work because they're not getting paid. Now they've got food banks for people who work at the airlines because they can't even afford to feed their families. You add the cost of high fuel to these airlines, they're really suffering, right? So airlines are going to get beat down. That's a really good one, Sophia. Absolutely right, airlines. But don't stand in front of something like Campbell's soup or, you know, Kroger, Dr. Pepper. Those are more risky because people are still going to eat, right? And I bring it up because, you know, the indexes are my sweet spot. I like to trade the indexes, but they are expensive. And, you know, if you choose a cheaper product, say, I don't know, let's go look at what AT&T is doing. Choose something that's a lot cheaper, you got a lot more choices. You know, you can sell puts on it, and as long as you can afford to own the stock, then those short puts could be something. Or, you know, you can trade the options on this easier in a smaller account. So don't feel like you can only short the markets with the indexes, because if I'm right and crude beats us down, everything's going to go down. Everything. Marziti, what's your take on this?
Sorry, distracted.
That robo vacuum messing with you?
No, I'm in a trade.
Oh yeah, yeah.
Um, um, are we talking about the election thing? I'm sorry. Refresh me.
The risk that crude is putting against the market this year.
Oh, it's going to be volatile as hell. All right, I cut this trade. I'm on the wrong side of it. Um,
I didn't mean to put you on the spot, but
no. It's fine. It's fine. The it's volatile right now. There's no question about that, in my opinion. It's going to be they mined the damn thing, and three ships, when I looked at it last night, had already hit a mine. And so I think it's fair to say that there's probably going to be more mines out there. They're still shooting some missiles and crap like that. Um, the new regime leader, he's still playing the whole terrorist thing, apparently. Hezbollah has been launching on Israel. There comes a point though where, we start to say, well, how many more missiles do we have to get into this? This whole business has actually been a blessing for Russia in a way with the oil thing because their oil reserves, which are considered gray market right now, but they're making money because people are coming back to them for oil. So I think that we're looking for um, you know, I hate to think this is going to be another Iraq situation where we have all these, in Afghanistan, we have all these insurgency pockets all over the place, and we end up dragging this thing out for years and years and years. Israel's more than happy to do it. The U.S. does not want to do it. Trump probably does not want a war that goes on forever and ever and ever. And that does not look good, especially going into the midterms. So, um, but I think Iran's going to be a pest. The oil is probably going to be really volatile. I don't think we've seen the high by any means yet, but I think also though that um, we'll probably have escort ships, minesweepers escorting uh, ships through the strait. So yeah, in that regard, there, I think I think we're seeing more. We've
The,
got
the,
more to go.
this is where I kind of got hung up, and is why I wanted to address it today. If you look at higher oil throughout history, what do we get? What do we get with higher oil? We get a higher dollar. We get higher yields. We get higher US dollar versus Japan. We get higher inflation expectations, higher cost for investment in things like AI, the big AI build out. We get lower markets, right? Like all it just combines and it starts to stack and it dominoes. Higher oil will collapse the global market if it doesn't get put back under control. And when they did that strategic petroleum release the other day, which by the way, even if it had made relevant, significant success, it would only have lasted a week. And it didn't. It barely made a bump in the road. So that bump, which was one of the largest strategic petroleum releases in history, had a shelf life of less than a week and barely bumped the market.
Well, bear in mind too that traditionally we want the summer gasoline prices to be cheap in the US because that's when everybody's taking vacations and oil becomes a big deal. Um, so, you know, if this oil business continues to drag out, then when we get into May, June, July, I think we're definitely going to see more oil strategic releases and to keep the prices down because it's just one of those things that people bitch and gripe and stuff about so people find something to gripe about all the time.
Always.
Um, and but you start messing with the cost of their summer plans and they really get upset.
We have
So,
to we have to try to consider if they can't resolve this soon, things are going to begin to domino and get worse. Um, the United States has been trailing behind global markets for a little while now. What I brought up here is the Shanghai Stock Exchange, and we can see that they're sitting up at the highs. This is a weekly chart. And if we go back to like 2015, we can see that there's a high higher than where we are right now. But if I was to knock the time frame down on this chart to even a 2-year or a 3-year, China is sitting at the highs of its 52-week range, or 104-week range, 2-year range. It's at the highs. China's doing fine for the moment, certainly doing better than us. If we look below that, we have Japan. Now, Japan is knocked back. It's underneath its 50 period, but it's still above its 200. It hasn't even touched the 200. We have. We're dancing around on our 200. So Japan's doing better than us.
160, 160.
If we start to lose these global markets and we can't come up and overtake them so that everybody is down as much as us, it's going to be one more check in the box, right? Here's the ETF MSCI, so another Asia ETF. This is the Eurozone. Just got down and tagged that 200. So they're weak. Another Europe one near the 200. Latin America under the 50, well above that 200. So, when we look at how the US is performing against its peers, our peers are outperforming us in the broader market. If we start to lose that and everything goes, I think everything's going to go. People haven't even really started getting defensive, but one of the things that we spotted today was CTA positioning. They have started to ramp up how fast they're exiting their positions. VC funds are still holding back a little bit, but volatility is getting up there. We start getting into backwardation and volatility. And then when we say volatility, we almost always assume we're talking equities, but there's volatility measures for bonds. There's volatility for gold, for oil, for FX markets. We start seeing volatility metrics in those various products begin to get elevated and start presenting in backwardation too. We could have a really nasty year on our hands.
Maybe would we be looking at a black swan event?
The thing about a black swan would be, can we see it coming or not, right? Like one of those Black Tuesdays, those out of the blue sort of flash crash scenarios. And at the moment, we're not there because we're seeing what's happening. But it's certainly possible. Remember, crashes come from the lows, and we're on the lows in a lot of things. We're testing the low of the range, the low of we're hitting major moving averages that were significantly underneath us, like the 200-day in the SPY. That's a level that was significantly underneath us, and we're almost there. In the ES, we are there. So yeah, we can crash from the lows. I don't think it's going to be a flash crash thing as much as just a bear market thing, right? Like 2022 bear market, where we topped out, rolled over, and began systematically working lower and lower and lower. Bounces off of key levels just faded out before we made new highs, and instead we developed lower highs, and then we would fall down and break those levels and make new lows. And we just worked our way down lower and lower through the year. So many people that were buying the dip in 2021, they took forever to realize that buy the dip wasn't working in 2022. Everybody kept thinking, oh, it's just a deeper dip. We're going to have to buy it down here. And then it would break and it would fall lower. And oh, okay, it's just a deeper dip. And they bought until, it was like April. I think that's when it really got nasty, and we finally had a much deeper drop. Because
Yeah, it was around March, April.
March,
Yeah.
April. Yeah. You remember that? We were talking about it in the Bullish Bears when it was like, I think they're finally convinced. And it got
Well, we
nasty.
got to remember, looking at the bigger picture. Now, I'm not getting political. I am not getting political, but Trump inherited a sick economy. Now, and a lot of this is because of COVID. We're not going to sit here and just say Biden, Biden, Biden. We're going to say COVID, because a lot of it was COVID. But overall, the economy, there were certain things because of the exaggerated spending and things like that. The economy was sick. And and it's like Mondani up in New York. He made a lot of promises, but he inherited a severely sick system, and now he's caught in the crossfire of it. Um, so take all the politics out of it, though. We have a sick economy. We're grossly overexpended on debt. We're adding dramatically to this debt with the war. Now, you can ask yourself, well, should we be in this war if we can't afford it? And the other question, though, is, well, did we have much choice with all the terroristic activities and this and this and this going on? We can argue that all day long. But um, in the end, though, um, we've got a sick economy. We've got a massive amount of debt. Crypto has collapsed. And uh, so that changed a lot because a lot of people looked at the market based on crypto. That's collapsed. The markets cannot seem to get up and stay above 7,000. We have been, if you go back and look at this on a weekly kind of candle, we are sideways for the most part, I think. A little bit going down. And, we talk about the bond vigilantes and all that kind of stuff. And there's a lot of players that are mad. They're angry. They're this, they're that. There's just all kinds of different things going on right now. What that tells us is it won't take much of a spark to ignite something. It really will not take much of a spark to ignite a sell-off. And, I think a lot of people want a sell-off. When we go back and look at history, our biggest gains come after our biggest sell-offs. COVID is a perfect example. And, they may take time, but we have these big sell-offs. People get shaken up, they get out of the markets, and then time passes, and then people get over the shock, and then they come back in. Um, and so, we don't need to be, um, we don't need to, do I think there's still a correction yet to come? Oh, yeah. Are we having one now? I think we're having uncertainty right now. The war, of course, is making that a lot of it. We have a lot of risk off because of uncertainty. And I think in the end, um, uncertainty has a tendency to get numb after a while. People just get tired of it. They get to the point where they don't feel it anymore. And, consider Ukraine, Russia. That was all the big headlines for the longest time. And now, when's the last time you heard about a Ukraine, Russia headline? Because nothing's changed. The war's still on over there, but people have gotten numb to the topic. And, from the news aggregate sites, your newspaper and CNN and NBCs and all this kind of stuff, that they got these metrics that say when people stop tuning into the story, we need to find a new story. And so they move on to something else. So, while everybody was screaming about the national debt, the national debt, the national debt, well, people are getting numb to it. And Trump's not helping in that regard because he is still adding to the national debt with the wars and all this kind of stuff. So we're looking for a new event. This war thing will play out. And we may be in it for some time. I don't know. But if we have declare victory and stuff like that, we go on to a new event. If we don't declare victory and we stay in it, it becomes old news and we go on to a new event. So, but we've had a lot of negative events lately, and I think there's still, I don't think it'll take much to really set off the market in a downside. I'm not saying it'll happen, but I'm saying it won't take much. And that's why we need to be, um, aware of the fact to say, okay, like when we say trade small, trade often. And I used to joke that the reason that Tasty said trade small, trade often is because they're a broker and they make a lot of commissions when you trade often. Uh, but there's a little bit of safety in that, hopefully, depending on how your portfolio's set up. So, but yeah, can we have I think there is to wind down. Um, I think that a spark can definitely move us even more to the downside. We know this is the midterm election. We've talked about that. We know that there's normally in late spring, late or early fall, something that we see the biggest dips in the market before we have the rallies um, that come after the election. So, um, the stars are aligning that we still have got room to go down, but it's also a window of time. The midterm stuff doesn't happen until after the summer. The and that's kind of a predictable thing versus we're saying, well, is there a flash crash, a black swan kind of event? A black swan typically happens when something is stressed so much it breaks. We do know that repossessions of cars and default on student loans has kind of gone up. And, that's something that, a lot of people are watching that as well. And, close this trade out. So I got that. But, yeah, good.
I think the macro
Um,
risk is real,
yeah,
and that we have an opportunity to short pretty much anything we want into at least July, August, September. And you can shop around, try to avoid staples, try to avoid energy, unless you want to go long. Um, you can take the risk in a size that you want. So, find smaller products if that suits your account size. It doesn't even have to be done with options per se, right? You can do it with shares of stock if that works better for you. Keep in mind that things that are typically volatile are on the way up are just as volatile on the way down, oftentimes even more so. In Gerald Appel's book of technical analysis that I've shared in the Discord so many times, he ran statistics and numbers on volatile stocks and how their risk to the downside is compounded so much more that if you're trading in a bullish backdrop, you could shop around for those volatile markets. But in a bearish market, trying to take green shoots, green shots long when you're waiting for a bear market to turn around and try to go up and get some counter trend trades, those volatile stocks are the worst thing that you would want to use. So when we're looking down and thinking about opportunities to the downside, you can break them into themes.
excuse me.
Airlines was a theme that I seen. I like that. Um, Shipping companies like UPS, FedEx, they might suffer quite a bit too because they're going to need those lower fuel costs. If we get more global impact and these tariffs broaden out into heated up arguments, we could see trouble getting different materials that we need to make things. So those costs could go up. Think about how Walmart's supply chain has shifted over the last few years. Have you been in a Walmart store in the last few years and noticed how different it looks compared to like 5 years ago? The Walmarts in my area are using so much more floor space for displays, much less shelving, right? Like they're just not offering as much product. But rather than having a bunch of empty shelves, they are making these really big displays of like boats or, the ATV vehicles and lots of mannequins, and they're just taking up lots of floor space with these. It's subtle, right? But it's there. They've redesigned their supply chain in a way that does not account for massive amounts of material.
Order submitted. Order filled.
And I think it really stands out. If we do get a broader market downturn, there are risk assets, obviously, that you can focus on. But I think it's going to break AI themes and quantum themes, drones. I think all of those are going to get hit.
Well, a lot of what you see at Walmart and places like that are what's called flooring. And what flooring is, for those of you that don't know, is where Walmart itself did not spend their own money to do this. Instead, let's just say Adidas shoes, just picking on Adidas shoes. I don't know. But Adidas is putting their own money into
Stock filled.
to put the display in Walmart. Walmart does not have their own money in it. And so essentially they rent the space to Adidas. They may not charge them anything for it. But the idea here is to free up Walmart's cash by, when you look at a store like Walmart, they put a dollar value literally on every square foot of their store. And it's called dollar per square foot. And, so they'll, for example, let's just making up some numbers here. Let's say that they sold $100,000 in a month. And let's say they got 100,000 square feet. Well, then they would say that each dollar per square foot is $1. Okay. And so they take that number very seriously because they want to maximize, they want to get that number up to $2. Well, the only way that they're going to get that up to, to $2, either they got to invest their own money and buy inventory, and they stand a risk on that because if it doesn't sell, the other metric that a retailer uses, and I know these kind of numbers because I used to have a brick and mortar store, is turnover per square foot. And that is, how many times per square foot does that spot get sold and restocked, sold and restocked? And that's an important number as well. But the thing of it is, so like, what that tells you when you walk into Walmart and you see more and more of these in the way of your dadgum buggy floor displays, because the aisles seem like they're getting more and more narrow, is that Walmart is not putting necessarily their own money into this. They're getting the manufacturers to put their own money into this. And that tells you that Walmart's keeping their cash free because Walmart's stuff is on their shelves. But these kiosks, these aisle kiosks, many times are from the manufacturer. And so what that's telling us is Walmart's trying to free up their money, their cash, but increase the sales inside their store. And so it's a double dip for them. They don't have to put their own cash in, and then they can increase the number of turns, per square foot and all that kind of stuff. So it's a double dip for them. It's a good thing. As far as AI goes, we're already seeing a lot of white collar middle management is already being laid off. It's just the way it is. They're already being laid off, being replaced by AI. And the Citrini report did not help. That report that came out about 2 weeks ago, for those of you that are not aware, the Citrini report a couple months, about a month ago, a couple weeks ago, was a thought experiment, as they called it. And they said, pretend it's the year 2028, and let's look back at what happened since 2026 in the past 2 years. And in the fiction, AI had replaced a lot of middle management. And initially, this seems like it saves companies a lot of money. But there's a problem. Middle management couldn't find new jobs. They go on unemployment. Well, because they're on unemployment, they don't have as much money to spend. So the companies that laid you off now, in many cases, their sales go down because there's not people to buy. Well, so what do? Well, they're trying to maximize their dollar. So what do? Well, they lay off more people and they go to more AI. And this just creates a death spiral of until the companies are just as lean as they can possibly be, and that becomes the new reality, where what they thought was going to be the most saving thing. If any of you've ever taken calculus, you've studied this concept of the tangents and so forth, and the idea is there's a sweet spot where you can raise prices knowing that you'll lose customers, but there's a sweet spot where you can get the most amount of money with the least amount of knowing that you're losing sales. You can still maximize it. Think of it like an apartment complex. Apartment complex has 100 units in it. Say they charge $1,000 a month for an apartment, just making up a number. Well, and they're at 100% occupancy. Well, they realize that if they go to $1,100 a month, let's say that some of their apartments may sit empty, but they're making more money because the ones that are full are paying $1,100. And when you tally that up, that was more money than being at full 100% occupancy at $1,000. So, and we studied these kind of things in calculus, finding that sweet spot. So that's ultimately, as AI comes in, as companies are going to be moving around, jockeying for position and stuff like that to find that sweet spot of losing sales to competitors, but maximizing profits. And remember, the markets love it every time a company lays people off. You say, why? Because they cut expenses. And if you have the same assets, but you cut expenses, what does that mean? Well, that means your dollar, that means your, uh, oh, what's the right phrase I'm looking for here? But ultimately, it means that you're making more money. I mean, not making more money, you're more valuable. You're more valuable because you have less debt, but the same amount of this, that, or the other. And so Wall Street looks at that and says, hey, they're more valuable. And all of a sudden the stock goes up. And people said, I don't understand why laying off is bad news. It's bad news if you're the one that got laid off. It's good news for the company in most cases, unless they have some really negative press. Anyway, sorry, Signet, I got on a roll there. All yours.
Nah, no worries. I was working to fill an order. I looked around. I want my SPY short call. It's going to be half my iron condor. And I wanted to know, where is the positioning right now? So I used a tool called Quick Options, and I went out to the term OI so that I could take a look at where is the bulk of the positioning happening at the moment. I'll just take a picture of it and throw it in the chat. I wanted to know how far out in time I should go, and I wanted to base that on where is everybody else right now. This is what I found. April, well, first March, right? And that makes sense because, March is the closest options expiration for OPEX. We've got the March one. It's really large. You can see all those puts. But then we've got April for OPEX, and then we've got June for OPEX. It really stands out, June. And I didn't want something too close, so April didn't interest me. We're already in March. We just skip right through May, and that puts us into June. If you look past that, it gets really thin into September, and then we've got December stands out in January. But those three are dealing with next year's drama, and I want to deal with this year. So that tell you just points me to June, right? So I want to go to June. We're running 2-to-1 puts in June, so that seems to be a common theme. Not as many puts as April, but that's where I'm shopping. So, okay, I know where I need to be looking. Now, what do I want? So I brought up the broker, and we had already discussed I want $2.50. $5 wide, give me $2.50. I found that in June at the 685, 690 strike. If you look at the open interest, there's plenty of open interest. There's just not a lot of trade volume here compared to the trade volume in other spots. It looks like 95 and 700 is where there's some really great volume. Even today, a big institution came in and made some positioning there. And I'm in front of that. I'd rather be there, but they wasn't offering me what I wanted. Now, granted, this hasn't filled yet, so I could try to fill on that other one, 695 and 700, but it's $210 and I want 250. So I'm holding out for mine. I'm going to try to work the order through the day today, but I'm not willing to compromise this position. So I will try today. If I don't get filled, I'm going to try on Monday. And this will eventually become the upper leg of the iron condor that I had argued about earlier. You don't have to use SPY. You can use the Qs, or you can use any random product that you like. There's certainly plenty of choices. Be mindful of what we've talked about today, though. We are considering the fact that the cost of energy is going to decimate business around the world, and it will eventually lead to a collapse in markets and destroy whatever's left of this risk on sentiment. That businesses won't be able to sell things, that they will continue to lay people off, that inflation is going to come back with a vengeance. We're going to have a higher cost of gasoline, higher cost of just energy all the way around. AI is not going to be able to continue its aggressive growth, and that everything's just going to get put on the back burner until we get this energy situation under control. And it will come to a head eventually, but we're basically making a trade that is arguing against a quick resolution of this whole Middle East situation. So if they resolve the Middle East situation, this trade is very likely going to lose and we're going to get run over. But that is the basis for our trade. So we might get challenged. Price might run up and fight against our strikes. That's not going to get me to close this trade. I'm risking half the width. And as far as I'm concerned, I'm willing to leave that on unless or until we break completely through and something in the chart tells me that I'm wrong, right? So I'd want to see price run up and say break into all-time highs. That would probably convince me that I'm wrong, that my short is misplaced or ill-timed, or just straight up I'm wrong and I need to do something about it. But I'm not going to set a stop or in any way let the P&L of this trade dictate whether I should stay in the trade or not. I'm going to risk the full amount. If you choose to trade some other thing, try that approach. I'm not suggesting that you should make a large trade and risk large money. You can make a small trade and risk a small amount of money, but try it without setting a tight stop. Consider the whole trade either all loss or profit. Don't try to mitigate that loss once you're in the trade by figuring you're going to cut it at 30% or 60% loss. Just assume it will be a max loss and start with that as your basis point. There's a lot of choices. There's some mega size markets out there. All of the mag 7s are shortable in this scenario, so you could pick any of those, but you could pick smaller markets, even more volatile things. Try to stick to things that should be punished in this scenario. So, pot stocks, I mean, they're already typically a bearish product. I wouldn't add that to this bearish list, right? Like I don't see where or why pot stocks would necessarily get involved, but say self-driving vehicles or um, electric vehicles, that area and that space has been having problems. Drones been having problems. Quantum. There's a lot of things to choose from, but try to find products that should suffer from higher energy costs and who maybe don't have a strong business model anyways, and definitely things that will suffer from higher interest rates, from inflation. Not that we think rates are going to go up. I really can't see a scenario where the Fed would come in and raise rates. And in fact, lowered rates is a risk to our trade because in the short term, they could cut rates and that can shoot the market to the upside. But if they're cutting rates because of bad news, well, bad news is good news, right? Bad news will force the Fed to cut. That'll shoot the interest rate to the downside. Markets will go to the upside, but that's not sustainable either. That's why they haven't wanted to cut. Every cut is like a bullet in the gun that they can use. It's a safety mechanism. So they'll hoard those cuts and they'll use them to try to solve some of this economic crisis that we see coming. How many cuts can they get? Right? Well, we're at like 3 point something. And if they're cutting in 25s, then they've got what, 4, 8, 12, like 14 cuts that they can do if they're doing them in 25 basis points. They just don't want to get to zero too quick and they want to spread them out and use them as they need to. But that's really the worst threat in a an overnight headline that could jar us and maybe trip our trade would be some headline that says the Fed's going to cut next week or the Fed's holding an emergency meeting to do a rate cut, because they've done that in the past and they certainly will again in the future at some point. Those kind of headlines would hurt. Otherwise, shop around and feel free to exercise with AI at this point. Reach out to AI and ask AI questions like, hey, if rising energy costs do become a global threat and risk the collapse of the global markets, try not to use that word collapse. I don't think it's going to like that. But, it's a threat to rising markets and prosperity globally. Then what sort of trades would benefit in that scenario? If we're looking at a bear market for 2026, at least the first half of it, maybe the second quarter of it, what would you trade? See what AI has to say, see if it could point you in the right direction. It doesn't have to give you the name of a stock. It can just, it can point you to sectors or industries. It can point you to various themes. I do like my themes. Themes are good to play. So, consider exercising and stretching out a little bit in your trade ideas. It doesn't have to just be straight calls. You can do stocks. You can mix those stocks with options. Try butterflies, iron condors. Limit your risk. In none of this scenario do you have to put a lot of money in play. Even just a little bit of money offers you an opportunity to participate. I would not try to go short in the energy names. Look at Chevron for an example. It's doing really well. I'm sure a lot of its peers are also doing well. They may suffer if you was to look at like the various refiners, or if you wanted to get into energy names like coal or nat gas, there could be some problems with trading energy. But I wouldn't mess around in the energy space. I would just leave that alone. Unless you wanted to trade the volatility of crude itself. I think you would need to be more nimble for that. Marziti said earlier, and I agree with him, I don't think that crude is done going up, but you're going to need to time that better rather than, trying to get long crude, because we would still need how long, how far out should we go in the options? How high do we think crude is going to go in general? And crude often acts a lot like the VIX. It's spiky, it's volatile, it makes big gappy moves on headlines, and it's a lot of risk. So I would avoid messing around with energy necessarily and instead focus on big value names if you want to try longs, or big growth names if you want to try shorts. If you talk to AI, talk to it about growth versus value and what good names that you might want to choose, or ETFs that you could choose to play in that direction. There are growth ETFs, there are value ETFs. You can open them up and just see the names that it's holding or trade the ETF itself. If you are in an account that won't let you trade options and you want to short the market, there are short stocks that you can buy. So then, you're literally just buying shares of a product that makes money when the market falls. You don't have to use options if you don't understand them or if your account won't let you trade them. There's ways to play it, right? So don't feel like you got to get into something that you don't understand if options are not your wheelhouse. I think that energy is going to break our global economy unless they resolve this war soon. And the clock is ticking. I don't think that we're going to make it to April. If this war is still on when we get to April, I think that's going to be the beginning of it right there. Now, as for how long it's going to last, we do have the midterms, and history has shown that the markets typically fall down in front of the midterms, and then at some point they rally back out, because we always rally at some point. So can't time that long, but it does suggest that by the end of the year we would be working our way back up. So I wouldn't go for next January or February. In fact, I wouldn't be short into, say, September or October at this point. But April, May, June, maybe July. July is kind of pushing it on the longer end of the stick there, though. I really like June at this point. And ask questions, please, by all means. Ask Kevin, Marziti, me. It's not like we got it all figured out, guys. We don't. But we can help you try to get it figured out, help you point you in the right direction towards resources or ideas or just more information, right? Chemicals. Yes. Hey, I don't know if you guys saw it when Marziti was talking earlier. I was looking at my stock charts list, and my stock chart list is running a couple of themes right now that that I tend to work on. One of those is the let me get back all the way to the main page. I broke down AI and then opposite of AI. And then I broke down military defense. Now, I needed to summarize this in a way that made sense to me, right? Because this is mine. But this isn't about military. It's not even about the war. It was about the military's ability to get rare material and the lack of that rare material and how it was affecting our military. So this is one of the themes that I've been focused on. I will post this right up in the chat. As you can see, its formatting is not very clear. So sorry if this just looks like some random trash. We will be going over Netflix 100%. Yes, I'm really interested in looking at Netflix. So there's this
It is
post.
the interior layout of a UFO. That's what it looks like. There's the first floor, the second floor.
Heck yeah.
Of your disc-shaped saucer that's super
I was
size.
thinking of the butt end of the Titanic, looking at it from the
Okay.
backside.
Okay.
Yeah, baby got back. So that's my military defense play. But we've also got diversified ETF exposure. So let me open that one up. Excluding the top 10, which is mostly tech, here's my little write-up for diversified ETF exposure. And the diversification is so that we avoid AI dominance, right? Just put that in the chat. There we go. And I'll put some little headlights on it or something so people can find the next one. All right. So they're ETFs, obviously, and the idea is to avoid the raw AI exposure. Worth considering, right? And then, of course, you can dig down into bullish percent indexes and various sectors and sentiment ratios, all that good fun stuff. Industries, bellwether technologies and bellwether industries, commodities and currencies. So let's go take a look at Netflix. How well do you think Netflix would do in a bear market, generally speaking? We don't have to guess. We know when there was a bear market back in 2022. And we can see through the 2022-2023 year, trying to get right to the January there. There's January 3rd. And there was the next year, December 26th, right there. Now, they had already started to roll over before the 2022 year started. And if you look at, like a SPY, it actually started out pretty decent. And then it fell down into the bear market. This was already falling, but it had a last hurrah, little kind of blow off top. And then, oh boy, down it went. So that's pretty rough, right? But look at where we're at now. We've already rolled over from last year's high, been making these moves to the downside, and now we got this sort of blow off top scenario again, except we're not at the tops. We're down at the lows, and it wasn't earnings. So think about technical analysis. The very definition is that we want to focus on normalized price action, understanding how price moves when it's behaving normally. And we want to anticipate in the future that this rational behavior is going to happen again. Signals, patterns, setups, all of it based on normal price action and the stock continuing to behave in a normal way. As soon as it quits behaving rationally, technical analysis drops a lot. So, how accurate is technical analysis in a market that's not behaving accurately? It is very inaccurate. It's very poor. Random walk is a really big deal. And when markets are misbehaving, it might as well be a random walk. So always be careful when you're trying to analyze a stock on trying to gauge, are you acting normal or not normal? Yes, it can tease you and it can tempt you with these really big gaps because we know markets don't like gaps. It generally wants to fill them. But is it enough? Is it enough to bring you in even though it's misbehaving? We've got an island right now, and if it gaps back down, this will be an island reversal. It's not a reversal yet. It's just an island. For all we know, it's going to keep the gap, check that 90, run back up, break the high, and keep right on going. We just don't know. What does bother me is this old market phrase that says, if 80, then 100. The reason it bothers me is because when you roll over and you go the other direction, if 100, then 80. And we did that. And we bounced back up aggressively, violently, like it really wanted to dispel the notion that it was going to get below 80, but it wasn't able to get back above 100. So right now, if I was looking for longs, I would want it back above 100. I'm bearish this, but I have a hard time getting bearish after such an explosive, violent move up. So now we've got to worry about this $90. We got to worry about that tail and this gap. And then, of course, the key to the whole thing. Why did it jump? That was a part of the whole M&A deal that they were involved in, right? And when they finally decided that they weren't going to do it, the market rejoiced and we had this big move. I think that's the reason, right? If there's more to it, by all means, I need to know so I can go, at least dig into it. I'm just running off the top of my head. But when you see that sort of behavior, you want the why behind it. 100%. It should not be a doubt. You want to be able to say, oh, yeah, no, I remember the day the headline came out about blah, 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 and boom, there it went, so that you know exactly what caused this. And without that, you should be concerned, because then we don't know if it's going to unwind or not. Not that we know for sure, anyways, but you know what I mean. You got to understand, why is price behaving the way that it is, not just the patterns that it presents, but the why behind the move. So this move was on February 24th. We could go back to February 24th if we could. It looks like it dries up on the 27th. I'd have to go to some other dashboard, search for Netflix, and then dig back before the 24th. But I'm feeling pretty comfortable with the idea that it's because of this whole Paramount deal and Netflix bowing out. And that gave us a temporary pop to the upside. It is certainly primed for more. Here's what I would like to see. I want to see higher lows. Right now, we don't have that. I know it might seem like we have a higher low, but we don't know that this is a higher low yet. By the end of the day, that candle could turn red, right? This is one green candle, and it's still inside of the previous bar. So even if the day does close green, because we're still inside of yesterday's bar, this is not a higher low yet. So 1, I want a higher low. 2, I want a higher high. And then 3, I want a higher low. This needs to prove to me and establish that this turnaround is real if I'm headed back to the top in my trade. There's a long ways to go. There's no rush. We're talking about getting back up to 135. Now, if you're taking
Netflix is a solid contender, and all I have to say is buy it, buy it, buy it.
Is that your Kramer?
Yeah, sure.
Yeah, I need to hear him one of these days and actually see what his voice sounds like. The
Got a little bit of a northern slant, but to be expected. But I haven't watched him in years, so I don't know.
I don't,
But
and I can't imagine his voice at all. I can't hear him in my mind, but I was thinking he would sound a bit like Jimmy Fallon or something. If I
I don't
wasn't
know.
going to run it back to 135, if I was taking something smaller, then I would need a breakout of yesterday's range to get this started, because we do have a little bit of a micro flag development here, and it could form into my failed bear flag play, which would owe us back to $100. Break out of yesterday's high, take a long, fight through the mid of this bar. That would be the add-in spot around 96, and then run the popcorn play through every one of those back up to $100. If it failed to keep the breakout of yesterday's range, then I would run that as the beginning of the short, get through the midpoint of the last red bar to add to that short, add more on the break below the red bar, target the low, watch out for the last $1, right? That last $1 range. But that wick is pretty scary. If you can bring that up on a volume profile and see where everybody was positioning on that day, that would be beneficial. Right. So there you go. If you're looking for the long and the short, and that would just get you to deal with this island itself, right? Rather than playing in the bigger picture. See, the cool thing about the way that I like to trade is it doesn't matter if the chart's a daily, a weekly, an hourly, a 5-minute. The style of my approach is the same, which is really nice, right? Because I don't know if my brain could handle 40 different ways to do it. I just like the one way. I do like hood. I think I'm still in some of this. I was long all of the brokers, and truth be told, I can't remember if that's one of my brokers that I was in or not. I should really look at that, because that ain't looking so good. This is a bear flag. The flag has lasted long enough that it makes me wonder if we're going to get a failed flag setup, which would owe us back to 120-ish. If we did get that sort of scenario, we're underneath the 200-day moving average. That's never good. We have some distance before the next earnings, so that's positive news. Let's get a little bigger here. All right, there's the candle of control. Let's use that one. We'll use that one. So there's the boss. GTFO, the boss. If you break to the downside, you can run the 111 and the 1236 right off of that one bar right there. That's for the short play. You can run it right outside of that green bar to the left, but I like this boss bar. Get above the mid for a long. Well, I think by now everybody has heard me say this, but I want to go long from the lows. The idea about the mid being a place to get long is that your long is proving you correct. So that's a great place to add to longs. I don't like to buy from the highs. So you just got to kind of read between the lines on what I said there. Long off the lows. It's agreeing with you when it gets through the half. So good place to add to your long position. Expect if your long is going to fail, expect it to fail on that line like it did back here when we rejected it. For a short, if you can reject off of the 786 to the downside, that's a good place to get short. So we just run it up like this. There's your 786, or you can run it from here, or you can run it from the last green bar, that bar right there. Start on the next one. So there's your 786. Long above 786 into the half. And there's your bear flag. Today, as a matter of fact, in the SPY, SPX, the ES, we had a beautiful 786 failed flag setup. The thing was just, it was just so pretty. I put it in the chat. The brokers are getting a beat down, and they have been getting a beat down for a little while now. And now I'm curious how my brokers are doing. Or do I have hood? I just honestly don't know. So let's see. Equities. Let's alphabetize them if we can. There we go. Too far. No H's at all. I went from E to G, so I don't have hood. I got ICE though. That's one of those brokers, and I'm barely still profitable in ICE. Oh, I should be looking at this column. ICE. Nope, I'm red. There's my returns. Highest to lowest. Still doing pretty good on some, getting a beat down on some, of course. So I don't have hood, which is good, I guess, because it didn't look that good, right? So for hood, you know, we're past the earnings, and we don't have another one yet for a little bit. The end of April. So I don't know if you want to get long in this or not. If you spread it out.
Not until Bitcoin and the crypto.
That is a very good point. That is a very good point.
I saw MicroStrategies now got, what was it called? It's a note swap thing they just came out with that's not tied to anything. It's for interest yield. Some kind of interest yielding thing, and they're saying, oh, you can get 10, 12% here, but it's not tied to a stock. And the article, as I was reading it over on Seeking Alpha, was talking about the fact that, like Bitcoin, it's not tied to anything and it could go to zero. Um, and but the idea it was some kind of dividend payer, because there's a lot of people that love dividend strategies. But you got to remember, if people could bet on the speed of a paper airplane going across the room, there'd be a ticker for it.
Yeah.
And you know, um, it's crazy. It's absolutely crazy. Yeah, MicroStrategy's coming up with some weird stuff as far as ways to make money and to keep people. I don't know. I haven't researched it, but I wouldn't be surprised if they're losing a lot of investors because, well, Bitcoin's going down. I finally liquidated my Ethereum after I was down, 20 or around 30%. And good thing that I did, um, because it, continued to crash and crash and crash. But yeah, any of these, so that's going to be Hood. I don't know if Kraken's got a public ticker or not, but um, now you said, well, what about Schwab and IBKR and Fidelities and all them for for them, as far as them they go. I think they're in a different group than I would put um, Robinhood, because Robinhood is so anchored to the concept of crypto. But that's my take on it.
Yeah, I always associate Robinhood and Bitcoin. There was a really good article that I had read last year I can try to find that made very strong connections to the Robinhood price and the Bitcoin price. Very strong correlated factors. I've got a list of cryptocurrencies under the other assets category. I didn't make this list on stock charts. You can get packages of stocks, prepackaged lists, and this is one of those prepackaged lists. So when you got in, Sophia, on Hood, was you long or short? All right. Well, let's examine that for a little bit. Some of the choices that you have as a long play in Hood. You're in at 74.75, so you're not down by very much at the moment, and it hasn't showed you you're wrong yet, right? So there's no reason to abandon the trade simply because it's down a little bit. It's not like we're dealing in futures. We we have lows down here that have not been broken, although we are, if we're using OCR style analysis, we are setting new lows. We are setting lower highs. OCR would be using these few candles here, right? So lower high, lower high, lower high, lower low, lower low, lower low. Broke this big bars low. This gap is closed, but it was closed yesterday, or actually it was closed back here. We have no other gap down here that we need to be worried about, so that's done. We can measure out the whole of the micro range that we're dealing with. So we can just measure this low and that high. That deals with this little bit of micro range right there. The concern right now is the depth of the breakdown from the previous bar, right? Just starting with something really simple, really close to us. If I look left and I'm outside of yesterday's low, then I want to know, how bad is it? Have I exceeded, say, 1.5 or 2% of the previous bar's position size? So we can go, here's 1.5, Here's 2.0. We can extend that. So we're not 100% below yesterday, but we are more than 50% more than yesterday. I don't like that. But it can rebound, right? This can turn back around. The thing that I'm concerned with is what made you look at getting long in hood, or when did you get long in hood? Because for all I know, you got in at earnings or something, or before earnings. Oh, you got in this morning. Well, let's look at what was happening this morning. That's yesterday's high, and that's yesterday's low. So at the open, we were above 50%. We had a bullish Globex that was holding above the mid. Not bad. And then it spiked at the open and it started to dump. So got a little squirrely here. That set the range until 10:30, and then it just got uglier from there. So in a situation like this, when you get into the trade, before you get into the trade, it's a good idea to have a plan. What was your plan when you got in? And I don't want you to feel like I'm putting you on the spot. If you don't have that plan, it's okay to just say, I didn't have one. There's nothing wrong with that. But if you had one, I'd be interested in hearing if the trade isn't working, what's the plan? I had a hard time with this when I was new, and I think I'm not the only one. I didn't really have a plan for what if it doesn't work. My plans were usually I'm going to take profit here and I'm going to take profit there. And I didn't really think about what if you're wrong and you're not going to be able to take profit at all. That wasn't really a part of my plan. The thing is, when we go to get into a trade, the only thing we know for sure, if we're willing to have the plan, is where we're going to get out if we're wrong. Because we don't know if it's going to be a good trade or not, right? We don't know how far the trade is going to go, but if we're wrong, we can know in advance how we want to get out of it. So before I get into a trade, I like to think about my answer and say, if I'm wrong, where am I going to get out? That way I'm not emotional. I'm not in it yet, right? Once we're in it, we're going to make decisions based on how much pain we're feeling. And that is not a good way to try to gauge our exit. So now it's not working, and we got to try to decide, when should I get out of this? No answer now is going to be a good answer. Here's why. Suppose you got out before the bell rang, and Monday you come in and it's at $80. You're not going to be very happy because you got out. You're going to say, why did I get out and take a loss on Friday? I should have just stayed in. It's at $80 Monday. On the other side of that, what if you didn't get out before the bell rang and you come in on Monday and it's at $70? Then you're going to be sitting there saying, oh, I should have got out on Friday. Why did I wait? It's at $70. And no matter what you choose, sooner or later, that is going to happen to you. And it doesn't feel good, no matter which one of those you choose. It's going to be very uncomfortable.
All right, looking at Hood yesterday on the 30-minute and marking the high to the low and drawing the fibs. Hood has tagged the 786 below outside the box. Full measured move brings us down to 72.32. It did tag, like I said, the 786 and then started to turn a little bit back north. I can see 74 maybe, anywhere between 74 and 74 and a half as a possible bounce back up. Now this is using yesterday's high to yesterday's low as the fib. On the other hand, let's take the OCR, 30-minute OCR, and high to low we stalled roughly on the 618. So the key here, in my opinion, is to watch the 236. So if we looked at the 30-minute orb, when we closed below, let's say on a 30-minute chart, below 74.10, at that point, based on the concept that if you close outside of the 236, you're going to the 50, then that's where we should have said, well, maybe I need to lighten or close or whatever, because we did move on to the 50, just on the orb, 30-minute orb. And, you know, so saying it's right, you need to have a point where you say, I'm wrong. I'm absolutely wrong. For me, I mean, sometimes you'll see a bounce on the 50. And we did see a bounce on the 50. It happened 12:30 Eastern. It hit the 50. It bounced. But it did not go back inside the box. And so there's another place where we might say, okay, I'm wrong. So this is our second opportunity where we could say, all right, I need to get out. At this time, unless there's news, I'm going to say, you know, we're seeing, of course, we're near the end of the day. Actually, we are done with the day. It is 4 o'clock with the regular trading. So it's not a matter of whether your trade was right or wrong. It's a matter of when you realized your trade analysis, I should say. It's not a matter of whether your analysis was right or wrong. It's a matter of realizing when we're wrong and getting out. And see, this was what tripped us all up this morning. For those of us that were the regular trading hours or the pre-market traders, we all kept getting tripped up this morning. I got tripped up. I was red in pre-market. And when I realized, and I posted a message up in the chat about this, when you realize that you're wrong, we have to just swallow our pride, get out of the trade, and look for the next setup, because we're not going to be right 100% of the time. So but we do have to have that line in the sand, and maybe it's a look left and say, I see a liquidity place. If it takes that liquidity, such as the opening morning trade, if I look at yesterday's low was 75.02. So I call it 75. And so you say, well, if it takes liquidity there, yesterday's low, and if I say it continues to push below that, then I need to get out. Now, that actually would have been a good place to go long, would have been at 75. I would have considered that as a possible place to go long, maybe. But then again, like I say, with the 30-minute orb, by the time we hit 74.10, then if we were closing consistently on the 5-minute or whatever below that 74.10, which was the 236, then I would have personally said, okay, I'm wrong. Let's get out. Now, if we're looking at it at a higher time frame and we go to the daily, we are, let me get rid of this tiny little fib I'm looking at here. If we're looking at it at the daily, using a Bollinger Band, for example, which I like Bollinger Bands, a lot of y'all know that, that would have been roughly the midpoint of the Bollinger Band, and that would have told me that it was Um, you know, a possible bounce area to go north or south. But again, then I would have to zoom in on the tighter time frame and say that you know, I go to a tighter time frame to look for my exit points for win or lose. Um,
The
based
idea
on
is to
yeah,
have a plan. If you don't have one, try to consider key levels. Some books will tell you a dollar amount. You might just decide I'm going to risk $50 and then I'm going to get out, or some percentage. I'm going to risk 50% of whatever. You can do it that way. You can use candles and key levels, but have something in mind that says, hey, my trade's not working and I need to get out. You don't have to get out of the whole trade all at once, especially since you're using shares. You can feather out. You can say, okay, if it breaks this, I'm going to take off 25% of my trade. And then if it breaks this, I'll take off another 25%. That way, you can slowly exit the position if it's not working for you. That gives it time to turn around. But having some form of an idea, because what you need is consistency. What we all do, right? We need a way to consistently decide, hey, this isn't working. And if you make that decision when you're in it, you will always feel bad about the outcome when it doesn't work.
remember
Oddly,
too, we're not criticizing your trade. We're not
no.
criticizing the trade because we don't know the criteria for your trade, necessarily the details of it. That's not what we're doing. We're simply offering advice to say, if you think your trade is going wrong, where are your exit points? And you may be willing to hold it. And okay, the Bollinger Band on the daily, lower Bollinger Band down here at 72.18 or 70, 72, 72.80, 71.80, call it 72. You may be willing to hold it down to 72 and add to your position there. That may be your trading strategy. We're not criticizing that. There is a significant low, I would say, at 72.32, it looks like. And that's based on the low of Tuesday, March 3rd. And I would tell you for sure, if it breaks below that and continues south, then in my opinion, I would get the hell out for sure. But the daily Bollinger Band was heavily bearish, and now it is turning horizontal. That's a blessing and a curse. It's a blessing because it means it could be going back north, but horizontal doesn't tell us which way it's going to go. So again, it's the trading strategy to we're not criticizing that. We're just simply saying if you think your trade's going wrong in the future or whatever, this is how we would get out.
So one plan that you can have is look at how many shares you have. Say you have 100 shares. Before you get in, you can decide to feather your exit, 25 shares and then 50 shares and then another 25. However you want to do that. That's one approach. Then it's the where should I get out? You can look at the totality of the range that you're in, because you're either trading a range or a breakout. If you're trading a range, look at the total range. This would be, for an example, the total range on Bitcoin, or for Hood, we could use the last high up here to the last low down there. And we could say, okay, well, that's our Hood range. And then you can define your exit based on that range. The whole idea is to have something, and the thing can change based on the chart that you're looking at. So don't feel like, what I'm showing now, it always has to be like this. If you don't have something, you can reach out in the chat. It's one of the benefits of being in a community of traders. Reach out and say, hey guys, I want to get in this, but I need a plan for how to get out. and see what the community has to say about particular exit points that might be really helpful. Maybe it'll be 50% of the zone, or it'll be breaking the bottom of the zone. Who knows, right? The feedback from the community will help you with choice selections. And then you, before you get in, you now have that as a criteria. If you make those decisions before the trade and the trade doesn't work, but you stick to your plan, you can at least look back and say, all right, it didn't work. What can I learn? And did I follow my rules? Yes. And you can be proud of that, right? Because not everybody follows their rules. So when you're following your rules, you at least know I'm growing as a trader. I followed my rules. This one didn't work, but I'll learn from it and I'll try it again tomorrow, right? And that's what we all do. We just try to be better tomorrow. You will feel much better about the trade, win or lose, if you executed it correctly and you followed your rules. And then you look back and you study what the trade did, what it gave you, and try to learn from it as best you can so that the next trade comes along, you're better off than you was before the last trade.
I was hoping that it's gonna get to 76 and I'm gonna just get out. So that was the plan, but no specific plan because I'm not good at chart reading. So yeah, that was the plan based just on price.
I like
Chart reading is
basing things.
definitely,
Yeah.
yeah. Chart reading is something that we all need to learn. It's a is a language kind of thing, if you will. And periodically I've done these what do you see little videos. I'll try and do more of those to help people understand what is the chart telling us.
Marziti,
But
that would be beneficial, I think, if you did some of that. I'm right there with her, as you know. Um, by the way, if anybody hasn't seen Marziti's, what was that night that we did that Wednesday night?
the fan line we did the other
That
night.
fan line video, I highly recommend you guys go watch that. That really opened my eyes on how to do it. I'm a visual learner, and it's tough for me to trade, period, on this type of stuff. I'm so used to being a long-term swing trader.
Yeah.
In this market, I'm just getting ripped up left and right. So yeah, Marcy, any of that kind of stuff, beneficial. I think, even if you do another, 1 hour session, webinar, that type of thing, you know, I just think it's, excellent,
Okay.
so
We can do
thanks.
those. We can especially do those what do you sees. What do you sees? Anyway, our type videos more often. And yeah, because it is looking at a chart is learning to read a language. I'm looking at this chart for Hood, for example. And again, this is not criticizing anyone's trading plan because everybody sees different things in a chart. My goal when I do like one of those what do you see videos is not to tell you how you absolutely should read a chart because everybody trades a different strategy and they're going to see different things in the chart. And if you've seen one of my what do you see videos, you'll know that I point out a variety of things. That I point out a variety of things that some people say, yeah, that one's mine. And somebody else will say, well, I see that. And somebody else will say, well, I see something different. And all of that is correct. All of that is correct. So, uh, that's so like I'll post what I see here on Hood. This is a 30-minute chart. And you'll see how I have marked it up. Again, not saying that I'm right. But this is how now the blue lines are the Bollinger Bands, the white one's the midpoint. The trend line, however, is the most important one
And you can see I've connected a low on the left to a low in the middle. The trend line extends to the right, and it doesn't translate very well from TradingView unless you really open up the picture and look to see the day breaks. But you can see essentially yesterday we broke below that trend line, hit that trend line, rejected. Opening candle this morning came back up to that trend line and rejected it. And so that would have been um, that's just a typical trend line breakover pattern that we see right there. But again, that's one of the ways that I see a chart. Now you may see something different, and that's fine. That's fine. The trick is, like I said, you got to have rules to your trading strategy, and part of those rules are is part of the rules are where do I get out, and that's one of the biggest, hardest things to do there because a lot of us really get stuck with hopium, and I've been guilty of it. Oh my God, have I been guilty of it? I got run over in a trade a couple weeks ago. I threw an SOS out to Signet to help me because I was so rattled I could not make sense of what was going on. And, that was community thing that I was so grateful for to this, so grateful to Signet there because he was willing to say, let me look at your trade. And, I still lost on the trade, but because he jumped in to help me, the loss was minimized dramatically over where I was. And I was appreciative then. I'm appreciative now. Thank you, Signet. That's community. But the point being is that even I get run over sometimes, and even I get scattered. I got scattered this morning. And when I got scatterbrained this morning with all that choppy price action, what I realized was walk away. I was red, and I realized I was getting frustrated. And remember, that frustration leads to anger, and anger leads to revenge trading, and revenge leads to blown account. So,
Let's do an example on this. I got hood up. Your entry was 74.75. How many shares did you use? I can use an example. You don't have to tell me. I can just say we got 100 shares, right? And I want to have a risk plan in place. So let's say I want to use 15% of the total amount of money at risk. If I bought 100 shares and I bought them at 74.75, then I've got $7,475 max at risk. Now we know the stock isn't going to go to zero and that you're honestly not risking this full $7,500, but that's the money in play. So I can then say, hey, I want to know what 15% is. Calculators can be kind of funny, so I just cheat a little bit with this. I always hit the minus sign. I'm going to type in 15 and just hit percent, but I'm not going to hit enter yet. 15% of $7,400 is $1,121. I can look at that and say, you know what? That's not what I want, right? Maybe I don't want to risk that much. I'm going to risk a smaller amount. So start over. You put in your 74, 75, and how many shares do you want? I just looked at that, and 100 shares with 15% did not make me feel good. So maybe I'm only going to do 50 shares, right? So now I got 74.75 times 50 shares. That makes $3,700 instead of the other number we had. And I can now go minus 15%, $560. Okay, I'm much more comfortable risking $560. I guess I'm only going to use 50 shares for this trade instead of 100, and I'll get out if it risks $560. So now I know how much I'm willing to risk, right? This isn't the only way out, and it's only one random number. I chose 15%. You can choose 10%. You can choose 50%. The numbers that you can use to adjust is, well, how many shares am I going to use? If you decide that you only want to risk $100 per trade, and that you think 50% of your max risk is acceptable, it'll tell you how many shares you should get, right? You can just reverse the math and say, I don't want to lose more than $50, and I need to know where I'm getting out if 50 is my risk or 100 is my risk, so that at the bare minimum, you can use the math. And I put some of that in the chat. I just wanted to demonstrate what it looked like if you was using a calculator. Get really comfortable with a calculator. And the funny thing is, if you don't want to use the calculator, AI will do it for you. You can tell AI, hey, I'm looking to buy a stock that is $75 and whatever change. How many shares should I use if I don't want to lose more than, and tell it what you want, right? I don't want to lose more than $70. It'll tell you, don't use more than this many shares. And then you know, right? Then, so you don't have to have this set answer that you're going to use every single time. You can adjust the plan based on each individual trade that you're about to do. Just try to have a plan before you get in about what if I'm wrong? Because unfortunately, that's the only thing you have control of. We have no control over what if I'm right, because we don't know if we're going to be right, and we don't know how right we're going to be. But if it starts to lose, we can know exactly how much we're willing to lose and where we're willing to get out at. Some traders always use the same size of trade so that their math is the same every time. And instead of using dollars to get out, you can use shares to get out. If you get in with, say, 50 shares, you can cut that into exits. How many exits do you want? 4, 3. So if you have 100 shares and you're going to use 4 exits, then you could do, 25 shares per exit. You would still need to figure out where those exits are going to be, but you've already decided how much of the trade am I getting out for every one of the exits that I'm going to take. There's so many ways that you can do it so that you don't have to get all in it at the beginning and all out at the end. We've only been talking about getting out, but when you was getting in, you can consider adding a little bit at a time when you're getting in as well. Suppose you was willing to take 100 shares. You could start by getting 10, and then another 10, and then another 10. You could start with 25, 25, 25. There's no wrong way to go. I like to add in when a stock proves me right? Like that. I've always liked getting in when it proves me right, because it's confirming my bias. So if I think it's going to go up and I get 20 shares and it does go up, I can get another 20 shares. And as long as it continues to behave the way I had expected it to, I'm willing to keep giving it more money, right? Now, that's not necessarily a popular plan. Adding into winners is one way to go. You can get out of winners as they go, right? So if you got in at the low and as it runs, you're getting out in profit, that's really popular. So really, the choice is all on you. There's no wrong way to go. There's no right way to go, but having a plan is really helpful. And I don't want you to feel bad about this situation here, because I promise you, every single one of us has traded without a plan. And if it hasn't happened to every one of us yet, it will happen to whoever it hasn't happened to yet. It will happen to you. So don't feel bad. It's a rite of passage. We've all been there. The ones that survive are the ones that start using a plan. So you're still here. You're not gone. You haven't blown up. And there's always tomorrow. There's always another trade.
Thank you so much. I was thinking to enter at a lower point when I saw it, like it's dropping drastically. So I saw it was like 73.20 and it was going even more down, but I wasn't sure, so I didn't do it.
Averaging in as it falls is a dangerous thing to do. I don't want to say that you shouldn't do it, because everybody has to decide for themselves what kind of risk they want to take. And for equities, unlike a lot of other things, in equities, a lot of times they rebound before they fall even more, right? And so what I've seen people do in those sorts of situations is they buy more as it's falling so that it lowers their break even. And then when it bounces up, it bounces high enough to get above that new break even, and they're able to get out without getting hurt too badly. But that is dangerous. And here's an example of where that happened. It set a high, it closed here, and it opened here, and it ran up and it set a high, and then it fell. For 2 days it fell, and then it bounced up. So on that bounce up, it gave people a chance to get out. You might have gotten in, say, right here to begin with, and then added a lot more down here, and it brought your break even to this point. Well, on that
Yeah.
rebound, it got up enough to let you out, and then it kept on falling. So adding in when you're losing is a plan, but I do have to caution that it's a very dangerous plan, and it can make your losses a lot worse for a number of reasons. It doesn't have to bounce. It doesn't have to bounce right away, or it could fall a lot farther than you're able to hold or willing to hold before the bounce finally comes. So adding when it's falling can be really dangerous, and even that can have a plan. So, you don't have to wing it. You can say, all right, here's my plan. Before you get in, you can decide, I'm willing to buy this lower if, and then, make up some decisions about when would you add in if it's falling, and then, stick to that plan. That's a better way to do it than being in the trade and having it lose and say, gosh, I'm losing. I think I'm going to add in now. That is where the worst mistakes happen, because we're making decisions under pressure and in pain. We want to make those decisions before we get in so that we're not in pain and we're not under pressure.
Yeah.
Something that might help, especially over the weekend, there's, trading's done. We got time. Kind of pick a quiet spot with a notebook and a pen and write down some ideas on how you might want to get into trades, how you might want to get out of them, and talk to all of us next week. You can, put your ideas in the chat, ask questions. We're more than happy to help. There's no rush on putting together a plan. Just knowing that you need one, and it can be as flexible as you want. No one's saying that you've got to, play it ice queen cold and hit everything exactly perfectly or have all the answers, because I don't think any of us have all the answers. I will point out, while we're looking at the two of these, is that Hood might act a lot like Bitcoin a lot of the times, but over the last week, Bitcoin has been rising and Hood has been falling. They are not moving in the same direction at all.
That's not good news.
So
Answers I have, right questions you must ask. Yes.
correlations don't always last, and sometimes will diverge from those correlations. So Hood and Bitcoin, they're highly correlated markets, but we can't just ride on the idea that they always are moving the same. We want to check from time to time. And when I was putting these two together, there was a lot of times that they did behave well. Of course, Bitcoin didn't have earnings, but Hood did. So there was a little divergence during the earnings. But after the earnings, they got back together. They were performing pretty good. And then in this drawdown, which they both took a drawdown, Bitcoin rallied back up and Hood didn't. Hood just kept falling. So it disconnected again. I don't know how long the disconnect is going to last. Looking in the past, the disconnects didn't last for very long. And it's very likely that one or the other is going to mean revert. But which one? Will Hood go up to catch up with Bitcoin, or will Bitcoin go down to catch down with Hood? And honestly, they could both mean revert and meet in the middle, which is just kind of hurts the brain to think of, but they can both do it. I'd say you took a sophisticated trade, though. Correlations is an advanced trade. So kudos to you for even taking an advanced trade like that. When I was new to trading, I was not trading advanced trades. I didn't know how. So that's pretty awesome.
Let's see how I get out of this.
Bare
But
minimum.
thank you so much for everything.
Absolutely. At bare minimum, think about reducing your risk, right? Like, I don't know how many shares you have in total, but if you can reduce the total position size, then you can reduce your pain level and perhaps find a way to hold on for a bounce if we're going to get one. And of course, sooner or later, it will bounce, but will it be high enough? Will it be far enough? And will it be soon enough to let you out without too much pain? Therein lies the trouble, right? So next week is FOMC. Everybody be mindful of that. Really know what you own. We're expecting a sideways week into FOMC because that's what FOMC does. But I have plenty of examples where we didn't go sideways when we were supposed to. So just because that's what we're supposed to get, it doesn't mean that's what we're going to get.
Well, like I said, for those of you, I mean, I had a position in ETHA, an Ethereum ETF, and I lost 30% in it. And it was a pretty, dollar wise, it was a pretty good sized position. It happens. It flat out just happens. And so, again, this is not one of those things where you need to say, oh, I'm a terrible, even us experienced, you know, I don't hold a candle to Signet, but, I'm not a new trader either. So my point being though, is that, we all take losses and we all kind of, we get mad about it and all that kind of stuff too. But I mean, if you go to any of your big brokerage houses like, your Merrill Lynch's or your Bank of America's, and you say, here's my money, I want you to invest it for me. And they put it into a portfolio. I can guarantee you that if you go back, 6 months later, some of the holdings are going to be down 10, 15, 20%. Now, hopefully the bulk of your holdings are up, but they look at the portfolio as a whole, not as necessarily as the stock. So it's not unusual by any means to have a portfolio with losses in it. And from a tax standpoint, you'd have to talk to your accountant about it, but from a tax standpoint, those losses can be used for certain things called a wash sale. If your overall portfolio is really, really up in some cases, then you say, well, okay, I've made way too much money. I'm gonna pay a fortune in taxes. But if you've got some losses, that offsets it. And that's a strategy that a lot of them do. So again, like I say, I agree with Signet. Don't be upset about taking a loss. I know it hurts, it's painful or whatever like that in the short term, but remember that investing and trading is a long-term game. And it does involve a lot of education, and I'm gonna be quite honest, it involves a little bit of pain because a lot of times we learn the most from some pain, sad as it is. But anyway, I'll shut up on that. On that note, I'm signing off. You guys have a good weekend. As usual, Signet, thank you for taking the time with us. Um, and you know, make sure that you appreciate your moderators, Signet and Kevin. Um, Signet especially because he puts up, Kevin is taking live trades and he's making profit as he's trading with you. Signet's not making any profit off of this, not one penny of profit off of these, as far as trades while we're talking necessarily. So what you're getting here is just unbiased wisdom, advice, experience, and stuff like that. You guys make sure that you understand that, what you're getting here is the real deal. So on that note, I'm out. You guys be good. Signet, thank you. We'll see you guys Monday.
That SPY call that I was trying to get in didn't fill, so I'm going to try again next week. I'm going to add Amazon to that next week as well. As long as we stay underneath that 10-week, then I'm going to try to run short on Amazon. Whatever I do decide for that short, I'll let you guys know. And if I'm not in it by Wednesday, then I'll explain, just like I did today with SPY, the logic behind it. But the logic is going to sound very much like today. I think the broader market is going to feel pain. I really do. And I don't think that that pain is going to be very picky. I think it's going to spread out across most of the indices, and that you can pretty much just pick and choose whatever you want to short. I think they're all going to feel it. And the only thing that's really going to risk this trade is the FOMC doing rate cuts and or peace in the Middle East. And I don't know about you guys, but I don't see peace in the Middle East anytime soon, unfortunately. Right? I don't want to prosper from war. I don't want to even consider the fact that, war is happening, but it is, and we got to eat. So, I'm going to trade it. I hope you all have a good weekend. If you have topics that you want to hit on, ideas that you want to cover, got charts you want to look at, by all means, ask in the chat. I love getting those topic requests, and I will see you all next week.